While the weight lenders place on different factors will vary from one lender to another, and from one loan program to another, and from standard conventional to government-backed lending, the factors that underwriters base their decisions on will typically all come back in one way or another to all or at least a few of the 5 C's of credit. Now, in case you've never heard of these, they are character, capacity or cash flow, capital, conditions, and collateral. Now, while these 5 C's generally apply to lending in general, not specifically mortgages, it's helpful to reference them as they help us to understand what's really important to a lender and to better understand their underwriting process. Now, you don't need to stress about the technical terms or understanding this in depth, but it's good to know and understand the basics of how borrowers are looked at by lenders if you ever plan on getting a mortgage or a credit card or any other sort of loan for that matter. Now, the better lenders feel about your 5 C's, the better your terms will be, and the better eligibility you're going to have for all sorts of things. But most importantly, you're going to have lower interest rates and things like that, and that means more money in your pocket. So let's talk about these quick, starting with character. So the lender who's going to be plopping down potentially hundreds and hundreds of thousands of dollars on your behalf, a stranger they've never known, is certainly going to want to know a thing or two about you. Namely, that you have character that they can trust, based on your past behavior, indicating a high likelihood that they can trust you to make the payments back to them as agreed upon. One of the primary and most widely understood standards for measuring a borrower's character is their credit score. So a company called the Fair Isaac Corporation created the metric more commonly known as the FICO score, and the FICO model has really become widely adapted as a standard in lending. Now, your FICO score shows lenders your history of credit lines, credit cards, and loans, and your history of paying or not paying them on time. Now, this C is the first and one of the most heavily weighted factors that lenders will look at when determining whether they lend to you or not. Just like a "you must be at least this tall to ride" requirement at a Six Flags, most loan types have a "you must have at least this FICO score to even qualify for a loan." And similar to a good driver's discount on your auto insurance policy, maintaining that the higher the tier your FICO score is in, the better the terms and interest rates offered on your loan will be. In other words, it pays to have good character. Now, the next C is capacity. And capacity is just like it sounds. It's your capacity or ability to make the loan payments. One of the primary metrics used in determining capacity is a borrower's debt-to-income ratio, more commonly referred to as DTI. Now, there's 2 parts to the DTI that lenders look at. You have the front-end DTI and you have the back-end DTI. Now, the front-end DTI is your total housing debt to gross income ratio. So this will include your first full PITI payment, principal, interest, taxes, and insurance, and any other payments associated with the housing. For example, any homeowner association dues. If, for example, a borrower makes $10,000 per month, and their projected total mortgage monthly payment is $2,500, then their front-end DTI is 25%. Now, as a general benchmark, know that lenders prefer to keep the front-end DTI of a loan under 31%. Although, depending on the loan type and the quality of the other C's, there are exceptions. The back-end DTI, on the other hand, is your total debt obligation to gross income ratio. So this includes any and all monthly debt obligations a borrower might have, including credit card and any other loan payments, including your projected mortgage payments. Using the same above example, if the same borrower had $1,000 of monthly credit card payments, then his or her back-end DTI would be 35% based on the total monthly debt of $3,500, and that's including his credit card debt and his mortgage payment. Just like your carry-on luggage needs to fit in the size checker at the airplane gate to get on the plane, your debt-to-income ratio has size requirements as well in order to make sure you pass the capacity test. Again, a general idea of what you can expect as a maximum total DTI is between 40 to 50%. Remember though, maximum DTI requirements will vary from one lender to another and from one loan type to another. But especially understand that keeping your DTI in check is as equally important as your FICO score. And similar to character, the better your capacity, the lower of an interest rate you will typically qualify for. Now, the next C is capital, and that refers to the amount of capital, in other words, money that a borrower is putting towards the deal. In the cases of mortgages, how much money a borrower is putting as a down payment. And just like in the previous C's, the height of the bar on this is also variable depending on the loan type and lender. as well as possibly depending on the character and capacity of the borrower. For example, if a borrower passes the character test but is barely scraping by on the capacity test, say if their DTI is near the maximum level, then a borrower might need to put more capital down to lower the debt to income ratio. In other scenarios, for example, with a VA loan, there might not actually even be any capital requirement for the loan. However, putting more capital down positively impacts an underwriter's perception of a borrower's case and can sometimes be used to offset other shortcomings or to strengthen a borrower's overall profile. Next up, we have conditions. And of course, conditions are pretty straightforward. They are stipulations made on the approval of a loan. So for example, if a borrower recently received a raise in salary and the higher salary is what is being used to qualify them for the mortgage, then the lender will likely list a requirement of a pay stub reflecting the higher salary as a condition of the loan. Now, conditions may be specific to the property type, specific to the borrower, or even specific to the climate of the real estate market or the local lending market, the national economy, or anything specific to the transaction. For example, a standard condition for most mortgages is that the property must be appraised and the appraisal value must come in and support the value of the sales price. Or, for instance, if the economy is contracting, lenders tend to tighten lending policies, so they might actually nitpick the details and come up with additional conditions as an added layer of precaution. And finally, we have collateral. Now, in most small residential lending cases for purchase loans, you'll encounter, meaning loans specifically for acquiring a property for the first time, the property the borrower is buying is the security, aka collateral. So just like for a car loan, typically, if you don't make the payments, they're going to take the car back, right? Same thing with real estate. If you don't make the payments or pay the taxes, then they can take their collateral back through foreclosure. So by having collateral, lenders have security in the fact that if they foreclose, they will then be able to sell the collateral to recoup the unpaid balance on the mortgage. Occasionally, a lender might require additional collateral to be pledged, but in most cases, when borrowing to purchase a 1 to 4 unit, the collateral of the property being purchased will usually suffice. Now, understanding the importance of these 5 C's to lenders will help you better understand and plan for, not just for your first time, but for continued success in obtaining financing for buying real estate. I'll see you in the next video.